How much is life insurance for a 70-year-old? We're going to walk that through with my partner expert, Jason, who specializes in very specific insurance. So we're going to talk about how much is it for a 70-year-old and three other very specific items. Number one, how do you determine the right coverage for someone who is 70 years old? Number two, the importance of choosing the right insurance, the life insurance, not death insurance, which is what most people are offering you, especially all of the ads on TV. 90% of them are offering you what we call term death insurance. Might be super cheap, not valuable at all for you and your family. And then number three, Jason and I will cover the common mistakes that people make in decision-making around life insurance and what you need to be doing right now. So listen all the way to the end of the video to get every tip that you need. So let's go listen into our interview with Jason and I around these topics. So welcome back, Jason. I know you've been on a few videos, and those of you who haven't seen some of our other information around life insurance, go to our search bar at the top. There's a ton of information around life insurance, the right kind of insurance, and the kind that can lead you to generational wealth. So Jason, welcome.
Thank you. Happy to be here.
So let's talk about number one. How do you determine, around a 70-year-old age, because that was just a search term that came up and somebody wants to know, do I buy life insurance at 70? What's your thoughts on that, and how do you determine that?
I'll answer the second question first. Should you buy life insurance at age 70? Absolutely. How you determine the right coverage or the amounts, that really is a person-by-person decision. Mm-hmm. And that's why it's important and actually crucial that you speak with a life insurance professional, one that can take a look at the situation. I mean, sometimes it may be determined by how much debt they have. Sometimes it's determined by, what their dependents may need. There's lots of different factors that go into that. So a quick answer to that question is really quite difficult to come up with. Sorry to kind of avoid it, but yet that's the reality.
So a question I know that probably families would have out there is kind of two-part. One, what if they have a pre-existing condition? Can they even qualify? Could they get some?
All depends on what that pre-existing condition is. Most of the time, yes, if they're in fairly good health. I mean, if they've had heart attacks or things like that, there's going to be difficult in getting insurance. Well, there's a lot of people that have medical conditions at that age that might not get the best health rating, yet they can still be insured. Sometimes that income tax-free death benefit that comes from life insurance is so critical, they're willing to go to the extra expense when someone has poor health to make sure that they get that.
Right. And then what do you say about those who could be looking and say, yeah, but my parent who's 70 is on a fixed income, right? They're living on their pension or Social Security, and they don't have a lot to put toward it. If I'm the kid, I can tell you, pay for them because it will be your death benefit later, right? So again, go to that expense would be my answer. What would you add to that?
Absolutely. And in fact, when there's more than one kid, they should join together and buy as large a policy as they possibly can. Everybody knows about OPM, you ways to wealth is other people's money. Well, you can also leverage other people's time. And in reality, you're leveraging the 70-year-old's time for the fact they're closer to statistically dying. And the bigger the policy, the cheaper per thousand it's going to be, right? And so it's much better for two to come together and buy a policy twice as big versus, say, each child buying one policy by themselves.
That's great insight. Talk a little bit about then choosing the right type. And I know you're going to say it depends, and it does depend, but give some of the variables. The difference, maybe start with term insurance, whole life insurance, universal life, maybe give a little description for those who have listened to our channel before, and then we'll go from there.
Okay. Yeah. Again, it does depend. When we talk about term insurance, and I've been using the term recently, or the designation is terminate insurance. It's going to terminate, right? Yeah. It's not going to be around after a given time period. Most of the time with somebody at age 70, you're unable to get term insurance after, maybe 75, 80. It's very, very difficult. So if you have someone, a 70-year-old, and you determine to say, okay, we're going to get a terminate insurance, a 10-year terminate that come 80, no possibility to get anything more. So you need to be very careful in that kind of insurance. Universal life insurance is basically term insurance. It's built on the chassis, if you will, of 1-year renewable term insurance. Most of those kind won't be away. And most people will fire back, yeah, but whole life is so expensive. Well, there's a difference between expense and price. The most expensive life insurance is the life insurance policy that is not enforced when you die. So you got to be careful there, particularly with the 70-year-old, to make sure that's something that's going to be around. So you want something that's permanent, something that's not going to increase. The premiums are not going to increase on a scheduled basis every year, which a universal life would do, or a term would do after that term time frame. That's really I think the most important things to know about the different types of insurance that are possible.
And talk a little bit about using it as a bank. Somebody 70 might not want to be as active, might not seem as attractive. Talk about why it should be attractive.
Like buying a house, as you're making your payments, you're building up equity in that house. So in the event you go to sell that, you're going to get that equity back. You also have the possibility to have some appreciation of the equity, right? A similar thing happens with whole life insurance, that you're going to have an equity in the contract, and that equity in the contract you can use as collateral for loans, collateral to finance things in your life, whatever that is. You can also, for the fact that when you do a whole life policy from a mutual company, which means the policy holders own the company, you then have right to, by contract, your portion of the company profit. Well, believe it or not, most people, this is not a newsflash, that insurance companies are fairly profitable companies. I want as much as that as I can get. And so it can be a source of income that the 70-year-old will never outlive. So in a sense, you can say, I can promise you that you will never be poor.
What a great insight. So those of you who have not been on our channel, again, go to the search bar, search for any other topics on life insurance. You'll see Jason and I out there. And sometimes I'm out there by myself talking about it, because we're huge advocates, especially when it comes to generational wealth and legacy building. And while you're here, I want you to subscribe to our channel, click that notification button, be here every day. So when it pops up and our video pops up on this thing called your phone or your whatever device you listen from, that you actually watch the video. Grab our journal and write down what you learned, what are you going to do about it. And over the course of a year, you're going to have an action plan that you would never get in any other channel, and the same consistent knowledge and philosophies. So if you have any questions at any time, go to askloral.com, ASKLORAL, and ask questions, make a request. So Jason, before we leave, I want to go into this third topic here. What are the common mistakes that you see in considering life insurance? I'm going to say the number one is that you don't even consider it because you just assume they're 70 and don't get it. What else are you seeing?
We've already kind of hit on a little bit. They purchase something that's going to terminate, right? Again, the most expensive insurance is the one that's not enforced when you die. I see that as a big one. And not having the discussion with the family, right? At someone that age, they most likely have children or even grandchildren. That needs to be a family discussion. When that discussion takes place, you can understand opportunities that are yours, financial opportunities for generational wealth, when that discussion is openly had with all the stakeholders of it. And another mistake is that you run into some policy or someone tells you something that actually is not quite what you think. You want to transfer risk away from you when you're talking about insurance, not get into some contract that's actually transferring risk back to you. And that's the three things that I can think of that would be the most common mistakes.
Well, and again, you want to have some conversation with an insurance professional. So in the link in the description below, click on the link. It'll take you right to a Calendly link to get on Jason or our team's calendar and have that conversation, at least learn more about it before you decide yes or no just from this initial video. So at least lean in, have a conversation and a strategy session with our team, and we'll talk to you tomorrow.